I think I'm in the bear rally camp, although the evidence each day since the lows in June are proving that wrong. But nevertheless, we are in the middle of August, and the middle of August is never a time to make big decisions. September's around the corner. That's when we find out what the markets really think.
In terms of waiting until September potentially to see what the markets really think, it feels as though there's been a decent amount of capitulation in the last couple of weeks simply because it has been such a painful move higher for so many asset managers. Do you think that pain is over in terms of short covering? How is positioning as we await the next potential catalyst for markets?
Yeah, I mean, really good questions. I think what we're seeing is the money still flooding to the United States. There's this continent, this landmass that we live on in Europe and Asia. It's got geopolitical problems. We've got wars. We've got a gas shortage. All the problems are over here and not over there. So that's why the capital continues to flow to the States. And so the S&P has made a relative high to the world. And I think it's the highest high in 50 years, right, today. So that it's a big deal. The flows into America keep on coming. And what you have is an expensive US market, which keeps going up, and the rest of the world, which offers much better value, but doesn't want to go up. So at some point, you've got to wonder when that's going to turn. It will turn one day. We never can be quite sure. But you've got the inflation differential on two sides of the Atlantic. You've got the price of natural gas differential. I know it's going up on both sides, but it's a lot more expensive over here. And you've also had the rate cycle move much faster over there. And so that's closer to the end than it is over here. So I think that geographical difference is a very important factor at the moment in markets. And yeah, people are probably underweight the bit that's going up, as you say.
Charlie, can I ask you about the implications for the UK, given we've had this red-hot inflation number, double-digit. It is a very strong number, and it doesn't feel as though this is a market that is similar to the United States. And we've had, huge show and tell already around Walmart and Home Depot. But the numbers here, if you read into the basket, there's just so much strength right across the board, some of it in discretionary, other areas that consumers simply cannot avoid. What are the takeaways for you as you digest this number?
Yeah, I mean, we saw the US come down last month more than expectations. This one's been slightly higher than expectations, and as you say, food and drink has been the biggest component over the last year. It's all about housing and energy and leisure, which I guess is the end of lockdown boom. Some of these things are temporary, but the bond market really has taken this in its stride. The 2-year gilt is saying higher rates coming, but the longer dated gilts are not saying that. The inflation expectations, the UK inflation-linked bonds, are not saying that this is a huge great shock. It is pretty modest, but you look across the commodity curve. Oil's at a 6-month low, or both Brent crude over here and West Texas over there. And most metals are down. It's food that's been a bit resilient, which is basically food trades off oil, because we have to remind vegetarians that you need to consume diesel in tractors to cultivate food, and so it really is gas is the last remaining problem in this what the central bankers call the transitory surge. But yeah, there are far more problems on these shores than the States right now, and that's reflected in market pricing.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.